Small business owners have two main reports that they need to understand front to back. The first, and I think most important for a small business owner, is the profit and loss report. The profit and loss report shows all income and expense items for your business, and it will show you the net income or loss of your business. The second is the balance sheet. The balance sheet is more like a tracking account of where everything sits in your business. So you have assets, you have liabilities, and you have equity. Assets are things you own that are worth money. Liabilities are things you owe people money on, and equity is kind of your stake in the business and what it's worth. Any transaction that happens at a bank will go to either your profit and loss or your balance sheet. For example, if you get paid $100 of income and it goes to your bank account, the asset will go up and income on your profit and loss will go up. There's a debit and a credit. You may want to memorize if you're an accountant, otherwise you're probably not going to, but you would be debiting the bank going up and you would be crediting income, which goes up on the P&L. There's other times that something will only happen on the balance sheet, both sides of it. For example, if you take out a business loan and get $100,000, again, you will debit cash, the asset going up, and you will also get a credit of the liability going up. So I think profit and loss reports are really easy for businesses to understand, business owners, because I make money, the income goes up, I have an expense, the expense goes up, that affects my net profit. But I want you to understand the balance sheet better. So you may have heard before assets equals liabilities plus equity. What does that mean? Basically means that assets is what your business has that has value, must equal your liabilities plus your equity. So let's take this through an example. Let's say you start a business and you fund it with $10,000. You would now have $10,000 of equity in the business because there would be $10,000 of cash in the bank. So your assets would be $10,000 and it would equal your liabilities, which are zero, you owe no money, and $10,000 that you put into the business. So you'd have $10,000 in equity. Now, if you were to take a business loan and you'd get $50,000 for the business, your liabilities would go up. And if you put it in the bank, your assets would go up. But let's say that you took a distribution of that and you took all $50,000 that you borrowed out. Now there would be no money in the bank, so you would have negative equity because you took money out of the business that came from a liability. Those two always need to balance against each other to equal the assets. So the balance sheet is a scorecard that shows that what you have of value must equal your liabilities and your equity.